Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, founding partner and chief investment officer with Englebert Financial Advisors, to discuss getting ready for 2023 as clients shift their game plan. Chris, it's great to see you. Welcome back to Trade Talks.
Thanks as always, Jill. Thank you for having me as well.
All right, you got it. And let's talk about 2022 as we are in the final weeks here with both stocks and bonds down sharply for the year.
Yeah, I mean, this year is going to go into the record books. I mean, it's been a very obviously unpleasant year, to be candid with you. Not only are stocks down at this point 20%, but bonds are down as well. Negative sentiment is still overwhelming out there, whether it's, what's going on in Ukraine, the economy, the investment markets. But this is all in the face of good third quarter earnings. So, I'm going to use my football analogy. We're behind. It's the fourth quarter. We're down by 20 points. What's the stock market going to do between now and the end of the year? And I've been saying for about the last month, the surprise, I think, is still on the upside between now and December 31st.
Well, what are RIAs talking to clients about as you go into the end of the year? Because you make a point that you need to watch how much they realize in losses versus gains every year, that you have to think about your losses as well.
Yeah, right now we're doing tax loss selling for obviously taxable accounts. And there's a unique situation going on this year because obviously the bond market has seen tremendous declines, worst year ever in the bond market. So we're going back to clients and saying, hey, you have an opportunity here to sell a tax-free bond mutual fund or a taxable bond mutual fund, realize a loss and swap into a shorter duration fund that right now is paying as much as their longer duration funds. So it's really giving them an opportunity to pick up some yield. The other thing that people have to be careful of, though, is they need to make sure that they tell their advisor how much in gains and losses they've carried over from year to year. We're not a CPA firm, but we look at people's income taxes all the time to make sure that they're not realizing too much in losses that they can't use or carry forward. So tax loss selling strategy is big now this year. And we actually think it's going to be beneficial with a lot of these bond funds in the years to come, that people will be able to utilize some of these losses going forward.
And Chris, let's take a look at some of the technicals here as we head into the home stretch. And you had made the point before that, we had a tough September, decent October, and thoughts about the S&P 500 as we get into the last couple of months of the year.
Yeah, I mean, a lot of the things that people have been looking at, are starting to alleviate themselves. There's a tremendous amount of cash on the sideline. There's a tremendous amount of bearish sentiment out there. And I've been saying ever since September ended, we saw a really good rally in October. November started a pullback, but, really surprised on the upside. And one of the other technical factors I like to point out is that the moving averages have come down very sharply. So it doesn't take much for all of you technicians out there to see the 50-day moving average start to turn up, cross over the 200-day moving average. These are all positive intermediate technical signs, and we think that's going to help the markets from now through the end of the year.
And what about the Nasdaq? At what point do valuations start to look really attractive here?
Yeah, I mean, we're getting to the point now, Jill, where some of these companies are trading below their pre-COVID lows, but yet if you look at their business models, they've actually been expanding the last couple of years. So if I was going to say where the surprise could be, it could really end up being in the Nasdaq between now and the end of the year. Some of these stocks could have a furious rally because they've been so oversold. Hedge funds that, they've been, software stocks have been a lot of the darlings of the hedge fund world, and they were dumped viciously in September. Again, I would be very careful about being, short big time some of these big tech companies, because it's not going to take too much to get them going on the upside between now and the end of the year. You could see some, rather significant gains in some of these names by December 31st.
And what about the Russell 2000? Last year at this time, it started to rally hard. Do you think we'll get a repeat?
Yeah, I mean, again, small mid-cap stocks is my favorite asset class on a relative strength standpoint. They've been doing very well. Every time the market starts to rally, the small mid-cap stocks have been rallying harder. I think the playbook's going to repeat again this year too, and it's going to be a race to the finish line between who does better, the Russell 2000 or the Nasdaq between now and the end of the year.
And how about oil? It's holding in here after a sharp decline.
Yeah, I mean, we've had a sharp decline all year in oil. We've had a bounce. Right now, I'm telling people to watch the mid 80 number. If we start breaking below that, the decline in oil could continue. But I would not be surprised. I mean, I was really calling for like $75 oil. I think oil stabilizing at these levels, but again, you've seen a big pullback in the price of oil, which is one of the inputs into the inflation numbers that are out there. And so what we're telling clients is that it's going to take a couple of months, but inflation is going to start to reduce, mitigate, and be in a better position heading into 2023 than it was in 2022.
And then, Chris, when we talk about the Treasury here, rates are over 4%. I guess the question you have to ask is how much higher? I mean, there are people who acquire mortgages under 3% who can technically make more on fixed income instruments. I think this is a really interesting phenomenon that we haven't seen in quite some time, at least what I can remember anyway.
Oh, yeah. No, absolutely. You're absolutely right. And we've been telling people all the time. I just had a client call in the other day. He's getting close to retirement and he has $50,000 left on his mortgage. And he was saying to me, I said, what's the rate at? He's like 2.75. I'm like, you're never paying that off because that is such a low rate. But to your point, that's exactly the arbitrage that you can create right now. I mean, there is another alternative out there. A couple of years ago, there wasn't, but you're now getting CDs in the 4.5% range. You're getting tax-free bonds in the 4.5% range. All of these things are now giving investors another place to go with their money, which we think is good because, again, we think that we're going more back to the 1980s where you had higher inflation, higher interest rates, and higher energy prices, but it still was a very, very good decade for stocks. And we think that 2023 is going to be a much more positive environment than what people realize.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.